What's going on, everybody, and welcome back to your Financial Dose. What we're going to be talking about today is pretty much the cornerstone of any investment strategy, and those are going to be mutual funds. So if you've never heard the term mutual fund before, what it is a pool of money that investors put together and use that pool of money to purchase different securities. Obviously, it's not the investors themselves that put it together, but they invest in a pool of money, and then the portfolio manager or the money manager takes this pool of money and invests that in various securities. So if you're buying a mutual fund that is focused on stocks, then you will purchase units of this pool, and this pool will then be invested in various stocks. Alternatively, if you invest in a bond mutual fund, instead of the actual fund buying stocks, the fund will be buying bonds. And the benefit to actually buying mutual funds as opposed to buying individual stocks is that for a very low cost, you can have access to a whole bunch of different stocks. For example, if you buy a mutual fund that invests in the S&P 500, so the top 500 companies in the United States, you have access to those 500 companies without having to buy one share of each company. Because the way a mutual fund works is if you put in $100 in the mutual fund, let's say every share within the mutual fund or the mutual fund share is worth $25, you're going to get 4 shares of that mutual fund. And those 4 shares of that mutual fund, or the $100 that you invest, will be split across the 500 top companies in the States. And that gives you exposure to the top 500 companies while only investing $100. If you wanted to yourself find exposure to the 500 companies in the United States, forget weighting them based on the market cap so that Apple is much bigger than a much smaller company, so you'd have more shares of Apple and less shares of that smaller company. Let's just say that you wanted to buy one stock of each top 500 company in the States. That's going to cost you a tremendous amount of money. Not only will you need the amount of money required to buy all the 500 stocks, but you're also going to have to pay commission on every new stock that you buy. So investing in a mutual fund enables you to reach diversification levels that wouldn't be possible by purchasing individual stocks. Obviously, there are other ways of reaching these levels of diversification, for example, purchasing ETFs, but that'll be a topic for another video. There are 3 ways that you can make money in a mutual fund. The first way is when stocks that the mutual fund invests in actually pay dividends. These dividends will flow back to the investors in the form of a distribution. If the fund purchased a security and sold that same security at a gain, so they made a capital gain on that security, that gain will also be passed to the investors in the forms of a distribution. Finally, if the mutual fund invests in a company that then appreciates but they don't sell the position, what happens is that the actual value of a stock within the mutual fund, so the mutual fund share price, increases. And this isn't something that you see in the form of a distribution, but let's say, as in the earlier example, you purchase 1 unit of the mutual fund at $25. Well, if the fund managers made good investments and those investments actually went up without them selling it, then the fund would say, instead of being worth $25, maybe worth $30. Now, as I said before, there are many types of mutual funds, but we'll go over the main categories. So the first type are equity mutual funds. Equity mutual funds is the same thing as saying a stock mutual fund. So it's a mutual fund that will purchase different stocks. So as in the example before, we talked about the S&P 500, this mutual fund would have the point of mimicking the S&P 500 or replicating that index. You can also have mutual funds that invest in various sectors. So you can have a healthcare mutual fund, you can have a technology mutual fund, you could have an emerging markets mutual fund as well. So there are very many different types of mutual funds, so it's up to you guys to sort of decide what you want to invest in. Do you want to focus on technology? Do you want to focus on the broad stock market? Do you want to focus on a certain country or a certain market? There's a lot of flexibility that exists when purchasing mutual funds. Another type of mutual fund is an active mutual fund versus a passive mutual fund. So an active mutual fund is a mutual fund that will try to beat a certain index. So if you buy the S&P 500 mutual fund, this would not be an active mutual fund because it's just tracking the S&P 500 index. We'd call this a passive mutual fund. An active mutual fund can, yes, want to track the S&P 500, but on top of just tracking it, they're going to try to, let's say, overweight certain securities. So let's say the S&P 500 index was 3% in Apple. Well, instead of only going in 3% in Apple, they're going to go say 5 or 6% in Apple. And what that means is that the fund manager thinks that Apple will outperform the overall S&P 500. So by investing more money in Apple, they will actually increase the overall return of that fund. This is one simple example of what active management is. It's essentially a fund manager or a fund manager and his team that will actually make decisions as to which stocks to buy and which stocks to sell to try to beat a certain market or index return. The downside to the strategy, though, is that it costs the investor a lot more money. So if you're buying a passive mutual fund, the fees that you should be paying, or the MER, so management expense ratio, which is essentially the amount of fees that you pay for the management of the fund, are around 0.3% in Canada. And I'm not talking about an ETF, I'm really talking about a mutual fund. But if you look at mutual funds that have active strategies, so it could be related to the S&P 500, it could be related to growth stocks, it could be related to value stocks, it could be related to any type of style, the management expense ratio is going to be between 1.5 and 2.5%. And at the end of this video, I'll really show you guys how much fees can impact your savings rate. And the problem with active management is that over an extended period of time, it's been proven that most fund managers do not actually beat whatever index they're trying to beat. So it really begs the question, is there really a point in active management? Personally, I'm a strong believer in indexing and benchmarking, so buying the index, buying different benchmarks, and not trying to beat the market, but to have a diversified portfolio that will be able to weather different storms that the market can throw at you. The next type of mutual fund is an income mutual fund. So by income, we don't mean dividend, because a dividend mutual fund would fall under the equity section, so it has to do with stocks. But an income mutual fund has to do with bonds. So you would be investing in a mutual fund that buys bonds, and you'd be getting distributions because these bonds pay coupons. So for example, if you buy on your own a $100 bond and that bond pays a 2% coupon per year, every year you're going to be receiving $2 out of that $100 investment. It's very similar for a mutual fund, except that instead of buying one bond, that fund buys hundreds of bonds. And the mutual fund will say pay 4% per year or 6% per year or 2% per year, but you buy that particular mutual fund to generate income year after year. And then we also have money market mutual funds or money market funds. These are mutual funds that invest in pretty safe or 100% safe guaranteed short-term debt. So we're looking at treasury bills, T-bills, T-bonds, stuff like that. And the rate of return is very low on these sort of mutual funds, but the point of these funds are usually for short-term investments. So if you want to put your money somewhere for 6 months, or if you want to put your money somewhere that is extremely safe, then you would be investing in money market funds. But again, don't expect to make a lot of money from them. So the next thing that we're going to be talking about regarding mutual funds are the fees. And honestly, this is one of the greatest drawbacks of mutual funds, because there are other ways to invest in diversified pools of assets like exchange traded funds or ETFs, but mutual funds are a lot more accessible because you can easily buy them through financial institutions. So you go to your bank, you call your insurance company, all these various financial institutions have access to different mutual funds. So it makes it very easy for an investor to do it, and they are professionally managed, so it's not something that you have to do on your own. You have somebody else managing your money for you. But that comes at a certain cost. As I said earlier, the management expense ratio, or MER, is definitely one of the fees that you need to be looking at. So if you're talking about a passive strategy, you can be paying around 0.3%, and if you're looking at an active strategy, you can be looking at almost 2.5% that you're going to be paying per year. So if you invest $1,000 in this mutual fund, every year you're going to be paying 2.5% of that $1,000, so $25, regardless of the performance of the fund. If the fund makes you money, great, you're still paying 2.5%. If the fund loses money though, that's too bad, but you still need to pay the 2.5%. Then you can also have sales charges or commissions that are charged to you when you purchase or sell a mutual fund. For example, if you pay a fee when you purchase the mutual fund, we call that a front-loaded fee, which means that you pay it as you get into the investment. If you pay a fee once you sell it, we call that a back-end load, which means that you pay the fee at the end of your investment term. Usually what happens is if you sell your investments within the first, say, 5 years of actually purchasing them, you're going to be charged a fee. But after those 5 years, you can sell and not pay a fee, and that's what certain investment companies do to try to incentivize you to keep your money in their funds. But as the competition within the financial industry increases with different products like ETFs coming in, offering the same diversification benefits as mutual funds but at a much greater cost, a lot of mutual funds don't have these commissions or sale charges associated to them. So you could buy them and sell them without paying a fixed flat fee. The only fee that you're going to have to pay is the management expense ratio. Now, as I promised before, I'm going to go over 2 examples where we're going to be comparing the actual money that you end up with after 40 years at different fee structures. So, for example, let's say we had $10,000 that we're investing for 40 years, and that makes us 8% return on average. So, from time 0, or the first year, you're going to have $10,000, and then if we look at 40 years into the future, without investing any additional money, just keeping that $10,000 but making 8% on it every year, you're going to actually end up having around $242,000. Now, if we add a 1.5% fee to that whole equation, instead of having $242,000 at the end of the 40 years, you're only going to have about $133,000. So that's a huge difference that 1.5% worth of fees can make year after year after year over a long period of time. Obviously, if you're investing for 1 or 2 years, an extra 1.5% isn't going to make that big of a difference. But if you're talking about making $133,000 or $242,000 over a 40-year stretch, that's a huge difference. That's why when you're looking to buy a mutual fund, it's very important to look at the MER and to actually compare the returns and the fees of the various funds that you want to invest in. But again, it's very important to remember that past performance does not predict future performance. So if the fund's been making 15% for 10 years, it doesn't mean that it's going to be able to make 15% going into the future. What you can do though is compare, in a good year, this fund made say 12% and the other fund made 18%, but in a bad year, the fund that made 12% only lost 2%, and then the fund that made 18% lost 25%. So there's also something called volatility that you need to keep in mind when picking your fund. If the returns go up and down a lot more, then you would say that that fund is much more volatile than a fund that has a much more flat rate of return or much less variation within its rate of return. So in summary, mutual funds offer great diversification benefits at a very low cost to the everyday investor. You don't need large quantities of money to be able to invest in mutual funds, and it's very accessible. You go to your local bank, online, insurance companies, you can really find mutual funds almost everywhere. Also, you could sell them at any point in time and you're not prevented from selling them. So there's no lockout period, meaning that you don't have to wait, for example, 2 years before selling them. Sometimes you may need to pay an early sale penalty, sometimes you may not. It really depends on the mutual fund. On the other side though, there are a couple downsides to mutual funds. So as mentioned earlier, obviously the fees are the biggest downside when it comes to mutual funds, because if you compare the performance of a passive mutual fund or an active mutual fund and an exchange traded fund, the ETFs cost significantly less than these mutual funds and offer pretty much the same return. So why would you want to purchase a mutual fund when you can easily purchase an ETF? The next thing is that mutual funds only trade at the end of the day. I mean, for the investor purchasing the fund. If you want to buy a fund or buy a mutual fund on Monday, you send in the order to the bank on Monday, you will only end up buying the fund at the end of that day. If you wanted to sell a mutual fund on the Tuesday, you will only end up selling the mutual fund at the end of that day. So it's impossible to buy 5 units of a mutual fund on Monday 10 a.m. and sell 2 units of the mutual fund Monday at 3 p.m. because on Monday you didn't even actually purchase the fund yet. You only purchase it at the end of the day. Another downside to mutual funds is something called cash drag. That represents the quantity of cash that the portfolio manager will have in the mutual fund. So for example, only 95% of the money invested in that mutual fund may be actually invested in stocks, and the remaining 5% may be kept in cash. And the benefit to doing this is, well, first off, if an investor wants to withdraw money, the portfolio manager doesn't need to sell stocks right away to satisfy that money demand. And also it gives them the opportunity to jump in if opportunities within the market arises. However, if the market's doing well and 100% of the money isn't invested, well, you're losing out on 5% of those gains because it's not invested. So instead of making 10% in a given year, you'd only make 9.5% because 5% of the total amount was not invested. So that's why it could be a downside, but the reason why they do it is to be able to satisfy the short-term liquidity needs that the mutual fund may have. So all in all, guys, I think mutual funds are a great investment vehicle for people starting out and for people who really want to have a hands-off approach when it comes to managing their own money. If you're interested in managing your own money, or at least interested to do a little bit more effort to try to spend less money on fees, then I would recommend exchange-traded funds. But at the same time, mutual funds are available everywhere, which makes it very easy to get started. So thanks for tuning in, guys. I hope you learned something. As usual, if you enjoy the content that I put out, subscribe and like the video. Don't forget to click on that notification bell so you get notified every time I upload a new video. Thanks for tuning in, and I'll see you in the next one.